Hey everyone, this is Ashish. Welcome to the channel. So in today's video, I'm going to cover vol skew. So I'm just sharing my screen. Okay, so before we talk about vol skew, let us first understand how do IVs behave at the money versus the OTM options. So usually what happens is that at out of the money options, the IVs tend to go higher than your ATM options. So if we, let's say this center point is ATM options, and if we are moving away from ATM towards OTM, so both on call side and as well as on the put side, the IVs will be higher. And that's why we have this vol skew kind of, not vol skew, we call it vol smile. So a smile form shape is created when we look at the IVs of ATM. ATM is somewhere here versus the OTM option. So as we go down the put side or up the call side, both sides IVs tend to go higher as compared to ATM options. So that's where a vol smile is formed. Now, this is an idea. This is an ideal case which usually doesn't happen. What happens is on the put side, the demand of options are more. Put options are more, probably because people want to protect their portfolio, or people are doing covered calls, so they're writing calls and they're buying puts. So that makes this smile a little skewed towards the put side, probably like this. Not exactly like this, but yeah, like this. So the demand of put options is more, and it gives it keeps put premiums higher, and that's why volatility is higher on put side, and that's why we see a skew. So that is called as reverse skew when the put side skew is more. And this happened in 80s, as I have read. After the crash, the demand on the put side increased, and that's how this skew developed. So let's look at the option chain and try to understand the same through option chain. So if the demand is more, if the IVs are more, obviously because the pricing is more. IV is not a function of option pricing. IV is not an input to option pricing. So let's look at here. So we have spot closing at 17,784. This is 13th April expiry option chain. So 17,784, which means we can look at 17,800. So if we look at 17,800, the call side, the call is trading at 153. And the put is trading at 97. So there's a huge difference between the two. So definitely we need to look at other strike because 153 minus 97, that's about 53 points, 52 points. So probably the weekly implied future is at 17,852. So if we go closer to the spot, to the weekly implied future, 17,850 strike, we can see that the call is trading at 123 and the put is trading at 121.55, which means our implied future is trading at 17,851 and a half, which is much higher than the spot. Spot might be at 17,784. So, but the implied future is at 17,850. I've done a video on this put call parity and implied future. If you guys have not looked at that video, you can check that as well. So now this becomes our ATM 17,850 for this week. If we go, let's say 300 point down the option chain and look at the price of 17,550 put option, which is trading at 30 rupees. And same way, if we go 300 points up the option chain and we look at 18,150 call option, which is trading at 26.7. So as we can see that an equidistant OTM option on the put side is trading higher than an equidistant OTM option on the call side, which means that the IV for this put option, which is 300 points down, is higher than the corresponding call option. If we go further away in the option chain, let's say we go 500 points, 17,350 put option is trading at 13 rupees. IV is 16.25, and 18,350 call option is trading at 9. So obviously the call option is trading much lower than the put option. So that's how the skew develops. And we can plot this in terms of premium options also. So let's say in an ideal world, this would look like something like this, wherein these are our ATM options, so their premium is higher. And as we move both towards the call side and put side, the premium drops. And if there is no skew, this is how it will look. Both will be both side, it will be priced same. But since there is a skew on the put side mostly, it may look like probably not. Okay, I'm not, but this should go like this. And this should see a sharp fall, something like this. Okay. Okay, I'm not good at paint, that's for sure. But this normal distribution curve, which is like this, if we have to convert this to a skewed on the put side, then these puts will be priced higher. So this will go like this, and then there will be a drop in the call side. Okay, so that is the put options pricing and about the vol skew. Sometimes what happens is that there could be a skew on the call side as well. This usually happens when there is a big positive news in any counter, or maybe in indices. You may want to check what happened during Nirmala Sitharaman candle. So once that news came, the calls obviously were in demand. People were not just covering their shorts, but the longs were getting built on that big positive news. So obviously OTM options on the call side would have started trading higher, and the skew would have been on the call side. So that is call side skew. So if we look at Opstra here and look at what does vol skew says. So we have Nifty vol skew, positive vol skew, which means the puts are priced higher. And if we sort it by negative vol skew, we get stocks like Idea, ITC, LNTFH, Coal India, GAIL, NTPC, most PSU stocks. So you have seen that PSU stocks were rising in the last week. They all closed higher, and ITC obviously is running. So if we look at, let's look at option chain of ITC also. Okay, so we have future closing at 269. So let's consider 270, and 290 call option is 3 rupees, and 250 put option is just 1.7 rupees. So as you can see that put option 19 points lower versus the call option, which is 21 points higher, is trading higher. It's only because that ITC has been running higher and higher every day, every week. So there's a good skew which is being developed on the call side. So one may look at, so how do we trade this? Whenever there's a vol skew, how do we trade this? So one good strategy to trade skew is ratio spreads. So whenever there is a put side skew in indices, index opens say 1%, 2% lower on some news, or let's say Russia-Ukraine war news. So obviously puts are expensive, and as we go down the OTM option chain, they become even more expensive because people are buying those put options as hedges. So whenever there's a big difference in IV of an OTM option versus the further OTM options, one good trade could be you buy a lower IV option and sell more number of higher IVs option and create a ratio spread. So it could be 1:2, it could be 1:3. Now, obviously, there are a lot of things which you might want to consider while deploying ratio spreads. But yeah, one thing to look for when you are doing ratio spreads is the skew on whichever side you are doing the trade on. So ITC, if I might want to trade this skew, then I would look at probably a ratio spread. So let's say 290 call option IV is 41. 270 call IV obviously is very less, 34, which is at the money. So if I buy ATM option of, let's say, ITC, which is 7.65, I buy it for 7.65 rupees and sell two options of 290 call options. Okay. So what this does is I get in a ratio spread. Okay. So it is happening for a minor debit. I'm getting a loss of 6,000 on the downside. So probably 1.8 kind of a debit is there. And I'm getting a cushion, break-even cushion up to 310. Okay. So for this series, that's like even 12% upside cushion for me. And of course, if it goes to 290 and expires there, then that's a sweet spot and I make the most profit out of it. So this is one, in fact, this trade is looking good to me, as we can look at other strikes also, but I mean, this is looking good trade for me to do. I mean, obviously, you will have to size your position accordingly. That what happens if it say opens at a circuit filter, or if it goes 10% higher from here in maybe next 2-3 days. So let's say next 4 days IV, and there will be an IV increase, of course, if it moves 10% higher. So let's say it goes 10% higher, IV increases by 5 percentage points, and in next 4 days, the price would be 10% from here, and I lose about 10,000. This T plus 0 PL is 9,950. So if it goes to 295 price on Tuesday, I'll lose about 10,000. So accordingly, you can size your position that, what happens if it goes 5-7%, 10% higher. It has happened many times with me. I had a call ratio in PVR, but that was 1:3 call ratio. So and it opened at circuit. So I had 1800, 1900, 1:3 ratio. So 1:3 is even more riskier than 1:2 call ratio option. So it opened at 2000. I had to square off my position. And then I rolled that entire position in 1900 straddle of April. So that happened in March, previous month. And I opened a new straddle in April. And within 1 week or so, that straddle decayed about 80 points. PVR didn't move much, and walls came down. So the entire loss was recovered. So yeah, this is one trade which can be done. Obviously, give importance to your position sizing and try to get out 1 week prior to the expiry. So this trade might be good to hold till 22nd. I think expiry is 28th. And if on 22nd it is, let's say, trading around 275 to 280 kind of a level, then it won't be a bad idea to just buy a 310 call option and hold it till maybe Wednesday or something. But definitely get out of it before Wednesday. Although this is ITC, it should not happen that liquidity all of a sudden dries up. So you should be able to exit before Wednesday for sure. Okay, what if I look at other strikes also? 300 is trading for 1.7, 1.9, and 280 is trading for 4.55. So if you want to do a relatively safer call ratio, then one can do 280 and 300 1:2. But one thing is there, I mean, unless you are putting some money at risk, the chance of making money is relatively lesser. So if you can go far OTM and make it for very little credit or very minor debit, but the probability of that trade making money will be much lesser than the probability of this trade making money. So unless you are risking something, the chances of making money also goes down. Okay, so that was one on ITC. Shall we look at more on the call side, or shall we look at put side skew? So Hero Moto, obviously because of that news, there's a good put side skew. I don't think any other trade looks good to me on the ratio side, on the put side. So if we go back to call side, I don't want to touch any PSU stocks. What else? India Bull Housing, again, I don't want to do that. Maybe we can look at SAIL. SAIL had, I think SAIL last 52-week high is around 130. So we can look at SAIL actually. The future is closing at 111. And if we look at 120 strike, it is trading at 1.85 with an IV of 48.33, and 110 is 5.25 at 44.83. How about 115, 125? 115 is 3.25 and 47 IVs is 47. 125 is 1.1. Not really great, any of these trades. I will have to do a shorter distance ratio spread to make some money here. Okay, I think I'll give it a pass. I think ITC looks a decent trade to me, 270, 290 call ratio, 1:2. Okay, I think that's about it. That's about skew. One other thing which I could probably cover in this video was a Zeal trade that I had done. So Zeal opened at 10% circuit, and obviously there was a huge call skew. It was trading at around 290 and 400 call option in April. This was in March month, and 400 call option in April was trading at 8 rupees, and 250 call option in April was again trading at 7 rupees. One of them was trading at 767 and one of them was trading at 78. So as you can see that, the call option was still what, 30% away, and the put option was not even 15% away. So there was huge skew on the call side. So either one could do a simple call ratio. I prefer to do a simple strangle because I did not want to buy any option at that high IVs. So I thought it is relatively safer to do a, not safer, but it'll be quicker to yield profits if I did a strangle as compared to ratio spreads. So that's what I did. I sold 400 strike call option and 250 strike put option, and within few hours, when the stock settled, the IVs crashed, and it resulted in good profits. So whenever there's a news and stock is moving in one direction, look for skew, look for strikes where IVs are higher, and see if you can make a ratio spread. Don't go with the 1:3 ratio at the start. Look, just try to do 1:2 and take good safety in terms of the percentage move which is there in the stock. So that's how you can trade call ratio. Again, like I said, you can do it on the put side as well when there's some news, some bad news, and the stock is moving down, and there's a good put side skew being developed. You can do the same ratio spreads on the put side as well. All right. Thanks for watching the video. That's all I wanted to cover in this video. Thank you. Bye-bye.